Thank you, Mr. Chairman. Mr. Secretary, thank you for being here. Our interest in this piece of this at this committee, of course, is CFTC, and with regard to the markets, I represent agricultural producers, corn farmers, soybean farmers, all want to manage their risk, and what they need to know is that they're going to have markets that are fair, transparent, effective, not manipulated by speculators. And so that's what we all want to achieve in this and try to deal with the issue of systemic risk. I want to ask you a couple philosophical questions with the issue of systemic risk, which we all have an interest in. And that is, in your opinion, what types of entities represent systemic risk and should be subject to the unique oversight from regulatory agencies?
Well, two broad types of entities. Let's talk about firms first. Firms that are major dealers play a critical role in credit markets generally, whose stability is vital to the stability of the system. They are systemic. There's no science in defining who meets that test. It'll change over time. But if they're in the business of providing credit, making markets work, central to market functioning, then they're presumptively going to be systemic when things are under acute stress. But as I said earlier, it's not just the firms. Where risk is centralized, like in clearinghouses or sometimes in exchanges, or where markets come together in the OTC markets or in repo markets, those markets too can be critical to the stability of the system. And that's why it's important there be a level of margin, set of standards in those markets that provide better protections against contagion, against the fires spreading more quickly. There is no bright line, though. You will never know in advance what mix of factors could make a firm or a market vulnerable to a run and whose failure might cause systemic damage. You saw in this crisis firms that were not very large. Bear Stearns, Lehman, Countrywide were not very large firms, but they played a role in these markets at a time where their failure caused a broader run on the system as a whole, and that's why it makes it hard. It's not just about size, it's more about risk, and it's something you won't ever know with perfect certainty in advance.
Let me follow up with that then. Do you believe that if you labeling an entity too big to fail implies that the government is going to prop up those entities if they become over-leveraged?
Exactly right, and I would never do that. But here's the basic challenge. Simple proposition. The riskiest firms have to be held to tougher standards, because when they fail, they cause much broader damage. It's not just the shareholders that bear the cost of that damage, it's the system as a whole. So they have to be held to tougher standards. So if you're going to make that distinction between a community bank that's less risky, better managed, and a large, complex global institution have to be held to higher standards, then you have to make that distinction. We do that now. Major globally active banks in the United States, we're subject to somewhat tougher standards than for other banks. Not tough enough, frankly, in my view. We make that distinction now. We have to make that distinction. I think we can do that in a way that doesn't create the moral hazard risk you're referring to. I think we can do that. The critical complement of that, though, is to make sure that when they manage themselves to the edge of the abyss, that you can let them fail without bringing the system down. Yeah. And that's why we need this kind of bankruptcy regime for banks, for bank-type entities, that gives us a credible capacity to let them fail without putting the taxpayers in this. So that's the balance. But you're absolutely right. And I would not ever support a regime where create the expectation we created for Fannie and Freddie. Mm-hmm. In the end, the government will be there no matter what. I would not create that, and we have to. And I think we can avoid that.
I hope so. That's one of the questions I get probably more than anything else from constituents that I represent is this issue of too big to fail, and how can these institutions get on a level where we, the taxpayers, have to step in and support them. And I want to shift gears on that note for a moment. As I think you perhaps know, I have a bill that would end the TARP program at the end of this year. And I noted that you haven't endorsed it yet. I want to give you an opportunity to do that today. But I think it ties into this question of too big to fail, because the TARP program now, it was designed, and many of us held our noses and voted for it because we thought it was designed to prevent imminent financial collapse. It has now sort of evolved into something more than that. It's got banks, insurance companies, auto manufacturers. And I will tell you, you've probably seen too, news reports, my colleagues have lots of ideas about how to use unspent funds. And it seems to me the best way to make sure that doesn't happen is to end the program. And I'm interested in your thoughts on that. Whether or not you're going to extend it, you have the authority to do that at the end of the year. I would like to see us end it, and I would love to see you endorse that.
It may surprise you to hear me say this, but nothing would make me happier than to end this as quickly as possible. And we are actually close to the point where I think we can wind down this program, stop making new commitments, and put it out of existence. We're close to that point. We're not quite there yet. Let me just explain why we're not quite there yet. We have now brought stability back to the U.S. financial system. Banks can issue capital now, and we force them to raise substantial amounts of capital. We have ended the temporary guarantees we put in place to break the back of the panic. We have been able to wind down most of the emergency steps we took, and you authorized. And you did the right thing in doing it. You saved the country in authorizing those steps. But if you look at the U.S. finance system today, there are parts of the system that are still very damaged. It's very hard to find a small business in America today that will tell you that they're not facing a very, very difficult time getting credit, holding on to the credit they had, getting new credit to expand their business. Housing markets are still very damaged. Commercial real estate, huge source of ongoing pressure on our system. Community banks across the country, still under a lot of pressure. So we have to be very careful to make sure we are not prematurely taking steps that would intensify those financial headwinds, weaken the recovery, reignite the kind of pressures we saw last year. That's the balance we're trying to strike. But I think we are at the point now we're going to be able to return very, very substantial amounts of money to address the critical economic needs, long-term fiscal needs of this country, because we've been able to achieve stability at much, much lower expected cost than we initially envisioned back in February. And you're going to see the President and I will be making some suggestions to the Congress in the coming weeks about what to do with this program, how to end it safely. And we're getting closer to that point.
Well, and if I might, Mr. Chairman, just as a closing comment, I just think that, and I know there are some of those issues that are still out there, but it seems to me at least that, you know, when you start sort of veering into these other areas, and people now describing the TARP program as a political slush fund, and taxpayers they didn't like it in the first place, they like it even less now. And you hear about it everywhere you go, is why is the federal government, why are my tax dollars going to bail out these companies? And you get this issue where you have the auto companies coming before the Commerce Committee here recently, and you've got 535 members of Congress asking them about where they're going to close dealerships or where they're going to have, you know, what they're going to do with executive pay and issues like that. It seems to me the best way to avoid that is to end this program. And any payments that come back in can go to pay the federal debt.